Okay, good afternoon, everyone. I'm very pleased to be with you. I'm going to say a few words about the policy choices that have been facing the Monetary Policy Committee at the Bank of England recently and in the coming months, and also the government. David's introduction mentioned that I previously, until 2014 this was Deputy Governor at Bank of England, where I sat on the Monetary Policy Committee for 14 years. But also just recently, at the end of last year, I finished a 5-year stint on the Office for Budget Responsibility, which is the independent agency that oversees the government's fiscal policy and does the forecasts for economic forecasts and fiscal forecasts for the government. And my remarks are going to embrace both monetary policy and fiscal policy. So before I get to talking about the very recent developments, the implications of what's been happening in the Ukraine, and recent policy decisions, I want to go back a little bit in time, just to talk about the recovery from the pandemic, because this is quite useful in understanding why it is the Office for Economic and Cooperation Development, together with some other international institutions, have suggested that the UK is likely to see one of the deepest recessions of all countries, all developed countries, that is, in the next year or two. And that relates to the situation of the economy early on this year. So during the pandemic, and particularly during the recovery, the bank's Monetary Policy Committee was trying to support aggregate demand as the economy reopened. Essentially, the health restrictions during the COVID pandemic reduced both demand and supply in the economy, because roughly a third of the economy, particularly the hospitality sector and the sectors facing households, consumer services, couldn't open during lockdown, and there were restrictions that made people less inclined to go out. But as the vaccinations proceeded, so the economy started reopening, people started going back to the shops, businesses started operating again, and so forth. So what that meant is that over time, both demand and supply were rising back quite sharply towards where they were before the pandemic started. Now, the bank implicitly had taken the view that demand probably needed a helping hand, that supply would bounce back quite quickly, but you needed to encourage consumers to be getting out there spending. And they were doing that through holding the policy rate, bank rate as it's called, at the floor, and also through buying gilts, government bonds, paid for by printing new money, in the rather loose jargon, what's known as quantitative easing. You may well have seen that term. Importantly, the Monetary Policy Committee assumed that the pandemic wouldn't have very much effect on potential output, the output that the economy could produce when not everybody was employed, but the economy was operating at a sustainable level of employment, the natural rate of unemployment, if you've come across that term. So what they were trying to achieve through 2021 was providing enough stimulus so that the aggregate demand curve, and here I'm using the analytical apparatus, which I hope you've been exposed to. If you haven't, you certainly will before you do the exam, whereby aggregate demand in the economy, total spending for goods and services, is a decreasing function of the price level. When the price level is quite low, the price of UK output, that means the value of people's wealth is higher. It means that we're more competitive against other countries for a given exchange rate, so the demand for UK goods will be higher. So that's loosely speaking why the aggregate demand schedule slopes down. And here I've got the price level on the vertical axis and activity, GDP, on the horizontal axis. And similarly, as far as the supply of goods and services is concerned, well, if the price that businesses can get for their products is higher, they're going to produce more. They'll be able to pay their workers more. The workers will be willing to work harder and so forth. So conventionally, the aggregate supply curve slopes upwards. And what the Monetary Policy Committee were trying to do was to get demand equaling supply at the right level of activity, which would therefore not generate any additional upward pressure on inflation or any downward pressure. So Y bar here is the sort of normal level of operation of the economy or potential output. Now, importantly, the Monetary Policy Committee didn't think the pandemic would have very much effect in reducing the economy's supply capacity, its potential output, a little bit through its effect on investment, because investment fell back during the pandemic, but otherwise not a very large effect. Unfortunately, this judgment turned out to be incorrect. So what we actually see is that the UK labour force is about 500,000 smaller than it was going into the pandemic. And basically, people who were participating in the labour market have moved into what's known as inactivity. So this chart here shows you the change in people aged between 16 and 64 who are inactive, going back to the start of the pandemic and since then. And what you can see is that the number who are inactive grew quite a lot and has continued to be about 500,000 higher than it was pre-pandemic. And that basically means that the economy started running into constraints in the labour market even before the economy had got back to pre-pandemic levels of activity. So, you know, we see that in the very low level of unemployment at the start of the year, which is back to the sorts of levels that we last saw back in the very early 1970s, before even I started my career. The level of vacancies at historically high levels and so forth. Lots of businesses complaining they couldn't get the labour they needed. So the labour market was very tight, even at the start of this year. It's quite interesting, though, to look at the causes or the characteristics of this rise in activity. Initially, during the pandemic, most of this was just associated with a rise in students. So people stayed on longer at school or went into further or higher education when previously they might have gone out to get a job. And you would expect that that's just a transitory effect, that as people finish that extra education, then they'll go back into the labour market and look for jobs. And indeed, that is happening. So these red bars have been gradually shrinking, and they should continue to shrink. Some of the withdrawal from the labour force is because some people have chosen to retire earlier. The thing about a pandemic, it makes you very conscious of your mortality. So some people may have decided just to stop working earlier than they otherwise would have done. But there's also this interesting yellow set of bars at the bottom, which is associated with an increase in people who are saying they're long-term sick, and that's why they're not looking for a job. And there's been a lot of discussion recently about what's caused this. Could it just be so-called long COVID, the after effects for people who caught COVID? And some of them we know it's had a very debilitating, long-lasting effect. But other countries, have long COVID cases, but we don't see the same sort of rise in long-term sick there. And there is a suggestion that the big rise we're seeing here may be partly connected with the problems in the National Health Service, that there's a build-up of backlogs of people waiting for operations and so forth, because the NHS just doesn't have enough spare capacity. But the bottom line from all of this is that about 500,000 people have left the labour force relative to the pandemic. And to put that in context, 500,000 people is almost 2% of the workforce. And that, you can think of, might reduce the size of capacity output, potential output in the economy by about the same, in at least the long run, 2%. So potential output significantly lower. What that means is that, as compared to my previous chart, where the Monetary Policy Committee thought they had got the right level of demand to deliver what they thought was a largely unimpaired level of potential output, it's actually turned out to be much lower. And the economy has therefore been operating with activity above potential output and what's referred to as a positive output gap, excess demand. And over time, you would expect that to deliver higher inflation. So even if we hadn't had all the developments in the Ukraine, the Monetary Policy Committee would need to have been shifting this aggregate demand curve back to deal with this overheating. And you would have seen a period of slower growth and rising unemployment relative to where we were. So that's one part of the story. But then, of course, the other part of the story is what has been happening in the Ukraine and the fact that the conflict there has led to very steep rises in the price of items such as energy, particularly gas, food prices, grain prices, fertilizer, and so forth. These have been very large rises. And these are commodities where the price sort of internationally determined. So this chart here shows you wholesale gas prices. So this is the price that people have to pay on the international wholesale market to get gas. It used to be, going back to the pandemic time, around about 40 or 50 pence a therm. And then you can see as the world economy reopened, it started rising up a bit again. The demand for gas globally rose. But then particularly since Russia invaded Ukraine, some big increases. Now, just to tell you what these various lines are, in the past, this is just the actual wholesale price of gas. But firms can opt to commit to buy gas in the future at a certain date. And that's referred to as the futures price of gas. And normally that's quite a good guide to what they expect is going to happen to the actual gas price. So forecasters like the bank and the Office of Budget Responsibility will often use the futures price to construct their forecast. They're using market participants' expectations. And what you can see is that the green line is going back to the March budget. So there was some rise in gas prices then, and it was expected to fall back quite sharply. As the conflict in the Ukraine has worn on through the year, so we've had bigger spikes up, particularly high just after the mini budget in September, not particularly associated with that, just happens to be the case, although it's come back down since, which is the blue line. Don't worry about the dashed line here, that needn't concern you. And the darker grey swathe here just shows you how the gas price has varied over the last 3 months. So essentially it shows you just how volatile things have been in the wake of changing expectations of how the war would evolve. But the key thing here is that gas prices, which affect the price of home heating and so forth, are about 10 times higher than they were during the pandemic period. And the important thing is that things like gas, a lot of the food we eat and so forth, where the prices have risen, we import a lot of it from abroad. So this rise in prices, which obviously adds direct to consumer prices, but it's not generating revenue that can be used to pay wages and profits domestically. And in that sense, it works very much like the government imposing value-added tax on products. The firms don't get any more revenue, but the price the consumer would pay goes up. So it's basically an imposed cost from abroad, which makes us worse off as a nation. And this is a big effect, given that energy, food are important parts of the household consumption basket. You're talking about a fall in real incomes of the order of 5%, so quite significant. Okay, in terms of the apparatus that you see in your classes, our aggregate supply, aggregate demand diagram, the way we'd model this external shock is essentially like this, that you're pushing up consumer prices, but not changing what's available for firms and workers. So it corresponds to an upward or inward shift of this aggregate supply relationship, puts upward pressure on final prices, consumer prices, but also downward pressure on activity and employment. There may also be an effect from these higher energy prices onto the economy's supply capacity. Businesses, some businesses that are very energy intensive may opt to close, things like that. I haven't shown that here, but there is an additional feature that is worth being aware of. So the key thing is a supply shock of this variety leads to upward pressure on inflation and falls in activity and employment. This sort of shock, an external terms of trade shock, generates a very uncomfortable trade-off for monetary policy makers. I mean, they can opt to try and lower inflation more by contracting policy and shifting aggregate demand down. But if they do that, they'll make the contraction in output and employment worse. Conversely, if they want to moderate the fall in output and employment, they would actually relax policy, as I've got it here, and push the brown aggregate demand schedule out, but that would generate higher inflation. So a key thing about this sort of shock, it creates nasty trade-offs. Okay, so let me actually turn to what the Monetary Policy Committee have done and what they're likely to do before saying a little bit about fiscal policy. Okay, the first thing to be said, lots of commentators say, well, why is the Monetary Policy Committee raising its policy rate, bank rate? Bank rate has gone from nearly 0 up to, well, it's actually 3 at the moment up here. So the Monetary Policy Committee has been steadily raising its policy rate through most of this year, reaching 3% just before the September mini-budget. Oh, just after the September mini-budget, sorry, just before the autumn statement. Now, people say, well, that can't affect the price of energy and grain prices, which are determined in global markets. So what good is this doing? And the key thing is that even if they wanted to do something about those prices, they can't. They can't do anything about the current overall price level simply because of lags. So when the Monetary Policy Committee lowers or raises bank rate or undertakes some quantitative easing, it typically takes quite a long time to feed through to have its effect on demand, getting on for 9 months, a year, and then that takes about another 9 months or a year before the full effect is felt through onto inflation, which is ultimately the MPC's objective. So what the MPC is trying to do at the moment, it's not really that concerned about the current inflation spike, but what it's trying to do is stop inflation getting ingrained in the system. And the way that would happen is through what central bankers refer to the second round effects. So you have this initial spike in inflation associated with what's happening to gas and food prices at the moment. And that might have 2 effects on how inflation evolves in the future. Firstly, because it lowers workers' living standards, it lowers their real wages, you might expect to see them pushing for compensating increases. And in some of the industrial disputes at the moment, on the railways, for instance, teachers in Scotland and university lecturers are on strike today, again pushing for a better pay deal. So workers may resist the squeeze on their real incomes. That's referred to as real wage resistance. But if everybody does that, it passes through into higher prices and so perpetuates the inflation. The other channel is through just raising people's expectations of future inflation. People have seen inflation go up to double-digit levels and think, well, that might happen next year as well, and consequently mark up wages and prices to reflect that expectation of higher future inflation. And what the Monetary Policy Committee are trying to do is to create enough slack in the economy that these second round effects are not too important, and they allow inflation to fall back relatively rapidly on the assumption that gas prices are going to fall back either because the Ukraine conflict is resolved or because people start finding alternative sources of gas, such as liquid natural gas. But in order to limit these second round effects, the Monetary Policy Committee does judge that actually probably quite a substantial recession is needed. So this chart here shows you central forecasts from the Bank of England for GDP, the level of GDP in their latest monetary policy report. That's the green line here. The Office of Budget Responsibility, what they were expecting back in March, which is the yellow line, so continued growth at a slightly slower rate. The economy grew quite rapidly last year because of the recovery from the pandemic, but slowing a bit. The forecast that they've just put out is this blue line, which reflects the higher gas prices and has a dip again before starting to recover. And that's pretty much in line with what outside forecasters, other independent forecasters, there are many of them in the City, the National Institute for Economic and Social Research, the OECD that I mentioned earlier. They have a picture that's quite similar to the Office of Budget Responsibility. The banks, though, is rather more pessimistic. Its forecast doesn't go out quite as high. It is, though, worth saying that the bank does take the view, partly because that the recession is so deep, that actually the rise in interest rates that its forecasts are conditioned on is not as deep as it need be. Now, I just want to go back to just draw your attention in this chart here. So this shows what's been happening to bank rate and what's expected to happen in the future by market participants. You can back this out from financial asset prices. This shows what was expected back in March. This is now market participants expecting a much higher path than they were expecting in the spring. And in fact, it was even higher just after the mini budget in September. This is the consequences of that somewhat reckless fiscal loosening under the short-lived Truss Kwarteng government. The thing I want to draw your attention to before we go on to the fiscal issues associated with this is just notice the gap here. So the level at which bank rate is expected to be is about 3 percentage points higher than was expected back in the spring. And if you go, if you look at longer term interest rates, the government typically borrows for 10, 20 years. It issues government bonds that are only repaid 10 or 20 years into the future. The yields on those bonds have risen by a similar sort of amount, getting on for 3 percentage points. So it means the government is paying a lot more for its borrowing than it had expected to have to do back in March. And that's one of the big factors that's changed the economic and particularly fiscal outlook, as I will show you now. So the outlook for fiscal policy looks very much worse today than it did back in the spring. So this shows you how public sector borrowing has changed since Rishi Sunak's March budget. And the outlook for the public finances has really worsened primarily for two reasons. One is the worsened outlook for the economy. I've shown you that people expect output to be to follow a lower path than they previously expected it to. That means tax revenues are going to be lower, more spending on things like unemployment benefits and the like. And they're reflected in these sort of lighter bluey-grey bars here. So they're adding about 25 billion to borrowing. 25 billion is about 1% of GDP, percentage point of GDP to borrowing, and particularly getting worse a bit further out. But the other thing that's really worsened since springtime is these higher interest rates. Not only a higher path for bank rate that's expected in the near term, but also these higher long-term interest rates, which are the interest rates that the government has to borrow at. And these are reflected in these darker blue bits. So notice that these are averaging a little bit under 50 billion a year. So they're adding 2 percentage points, roughly, of GDP to public spending year after year, and that would continue indefinitely. So the public finances have together worsened by about 3 percentage points. That's a pretty serious deterioration in the fiscal outlook. So the government has had to grapple with this, but also, of course, it's facing this the problem of trying to help households through the shock of these very high energy prices in the near term. So what it's opted to do is essentially subsidize households' energy bills by capping the average household energy bill at around about £2,500 at the moment. And that's the biggest chunk in this red bar here. It's very expensive. It was scheduled to continue for another year, and then Jeremy Hunt, in his autumn statement last week, indicated that he was going to switch to, still offered some support to all households. What we have at the moment is universal support. Everybody has their energy bill capped. He's going to reduce the amount of support that's offered to everybody, but offer some additional support to poorer households, so a bit more targeted. So a mix of targeting and universal support. So that reduces the overall cost. There's some additional spending the government has announced recently, particularly for the National Health Service and education, to deal particularly with some of the post-COVID problems. But then when we look further out, and there's this big hole that's got to be filled worth about 3% of GDP, 75 billion, the fiscal policy switches to one of restraint. So whereas previously the government was penciling in some, reasonably healthy increase in spending by government departments, growing at about 3.5% a year in real terms. Now they're projected to barely grow at all in real terms, just very low real term increases. And they will come on top of what will in effect be quite a squeeze over the next couple of years, because spending by government departments is fixed in overall cash terms. But of course, the things they buy have risen in price because of the rise in energy prices, and the cash limits were set assuming that public sector pay would not rise very much either. So let me just actually go back. So the picture here is that the government is actually really running quite a loose fiscal position in the near term. It's raised borrowing between 3 and 4 percentage points of GDP relative to what it was doing in March. So much more fiscal action going on in the near term, and then cutting it back as we go out into the medium term. But even then, the spending restraint that it's announced still has left quite a significant deterioration in the public finances. Essentially, what the government is doing here is it's allowing the public finances to take the strain when times are bad, and that's eminently sensible. If you look at the long history of public borrowing, basically it goes up in bad times. Wars are the classic example of this. The government, UK government at the time, financed World War I largely by borrowing, not by levying taxes on those who are alive at the current at the time, and then again in World War II. And then what happens is when you get to the good times, so the period of post-war prosperity, you run, it might be a modest surplus, or you just make sure that it's in balance and let the growth of the economy gradually reduce the ratio of public debt to GDP. So you see the debt to GDP ratio coming down, and then it's gone up since the early 2000s. First of all, because of the financial crisis, when the government had to spend a lot of money repairing the economy and getting the banks in shape. Then during the pandemic, there's another step up, reflecting the so-called furlough scheme, whereby people kept on getting the bulk of their wages, even though they weren't working. And then from here, where we are now, there'll be another step up, reflecting the borrowing to deal with the Ukraine episode. But the important thing, if you're going to take an approach like this, which is eminently sensible, it's like the state acting as an insurer. When you get hit by a bad shock, the government borrows and shares some of the burden with future generations. But it is important that in the good times, fiscal policy is appropriately responsible and starts to bring the debt to GDP ratio down, which indeed the Chancellor is proposing to try and get the public finances onto that sort of track. So I'm going to finish here. I'm going to leave you with some questions that you might want to discuss later. That's not particularly for us to discuss now, but questions that you might want to talk about with your teacher or consider after the webinar has closed. Presumably these slides are made available on the website, so you can look at them afterwards. And I will stop sharing and we can move to Q&A.
No.
I can't hear you, David. Right.
No, thank you very much. I really appreciate all of that. It's very informative. We've had a question in so far as well. Just for anybody else, if you do have any questions, feel free to tell them to your teacher and they can post them in the Q&A session as we're going along. But the first one that we've got here is, what would you do that is different to the current supply side focus that would lead to significant productivity gains, lowering costs, which could make us more internationally competitive?
Okay, now this is a very good question, because I mean, I painted a picture which is pretty gloomy. Okay, we're looking at output declining, unemployment will have to rise, maybe not excessively so. I think the OBR has it rising to about 4.5%, 5%. The bank forecast is a bit more pessimistic, possibly peaking around 6%. But given that I pointed out that we came out of the pandemic hitting the economy's supply capacity earlier than we expected because of the withdrawal of the labour force, what we'd really like to do is make the economy more productive. So the trust quartering motto, growth, 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 was entirely sensible. And, you know, governments should be looking at how they can increase output, increase growth, not at all costs, you know. You know, you may want to avoid things like climate change consequences of going for growth at all costs, but the only way you can make people better off, really, is by growing the economy. The mistake Truss and Kwarteng made, I think, was really to focus on tax cuts as the way to do that, boosting incentives, and relatively small tax cuts, and directed more at the rich. And empirical evidence suggests that they're really just not powerful enough to generate the sort of increase in output that will be necessary to resolve the problem in the public finances. And the market participants saw that, and that's why they reacted badly to the September mini budget. However, we know quite a lot about what drives output over the longer term, and it's basically various versions of investment. Aside obviously from the number of people in the economy, so you can increase the number of people working, say by getting more inward migrants or by getting people to stay in the labour force longer. But if you want to increase productivity, which is the amount an individual person produces, it's investment that's the driver. Either investment in capital, that's machinery, robots, stuff like that, mechanization that enables a person to produce more. Investment in the skills of the workforce, which economists refer to as human capital, so making just people smarter and knowing how to do things better. Investment in innovation and ideas, developing new products, inventing new vaccines, things like that. And finally, investment in public infrastructure, which often has the effect of making businesses more competitive, so a better transport infrastructure, for instance. So all of those four sorts of investment you want to foster. There's also some evidence that actually British management suffers from quite a long tail of underperforming companies. And actually, if you could do something to improve those not so good managers, that would also benefit. That's also a form of investment, if you like. You're investing in the skills of the managers. Now, helpfully, the Prime Minister, Rishi Sunak, has recognised this. He gave something called the Mays Lecture, an annual lecture while he was still Chancellor back in the springtime, which laid out his strategy for growth, which essentially relied on generating all these sorts of investment in the key industries of the future. And I would recommend that as something to read if you want to get an idea about where the government might be thinking of trying to focus its efforts in trying to get us out of a low productivity growth trap that we've been in for the past 15 years, it is almost now.
Okay, just following on from that as well, you mentioned in your slides that you should kind of borrow in the bad times but make it up in the good times, and there has been an argument by some sections really that have suggested that we probably should have been borrowing more as the interest rates were lower, as the cost of borrowing was lower, and maybe using some of that to invest in some of the things that you just mentioned. I just wondered what your thoughts on that kind of argument was, really.
Well, certainly there is a good argument. Just like a firm, it makes sense to invest more if the cost of borrowing, the so-called cost of capital, is lower. That's equally true for the government, actually. And I have quite a lot of sympathy for the argument that you should take advantage of a low cost of borrowing to perhaps undertake more public investment spending. That doesn't say you spend on anything willy-nilly, but particularly since public investment in the UK has been relatively low. Going back to what I said about investment, if you compare our productivity with those of Germany and France and the US, UK productivity is 20% lower than our peers, and it's basically because of systematic underinvestment by businesses. There's a low share of private investment, underinvestment by the government, low share of public investment, underinvestment in education, therefore underachievement there. So there's a clear sign that it's not only what economic theory tells you matters. The evidence is there that we're low on these things. So taking the opportunity of a low cost of borrowing to invest more in public infrastructure would have made a lot of sense. Now we've moved out of that very low interest rate world, but I think it's one of the criticisms of the austerity period following the financial crisis that it included bearing down on public investment when arguably we should have been doing more of that, and you could have borne down a bit more heavily on other aspects of public spending if you were worried about the overall public spending envelope.
Yeah, correct. Thank you. Okay, one more question here. Do you think the recently proposed gold-backed currency by China and Russia would undermine understanding of the US dollar, the pound, or the euro?
I mean, ultimately, the question about what currencies countries choose. The issue here is, what is a reserve currency? So it's not literally the currency that people hold, but they hold assets which are denominated in those currencies. So internationally, far and away, the most important currency is the dollar. And governments, central banks, private investors, if they want an asset they can rely on, which they can sell easily at short notice, said to be liquid, par excellence, that asset is a US government bond, in the jargon, a treasury, US treasuries. To some extent, we've seen some emergence of Eurozone assets, particularly German Bunds. So these are government bonds issued by the German government, starting to play the same sort of role. But there's nowhere near as much of that in issue, and it's nowhere near as dominant as the US dollar. Now, I'm not sure Russia, given the state that it's in, has a particular likelihood of becoming a key reserve currency, but the Chinese certainly did. One of the things I did when I was at the bank, I used to go to a lot of the international meetings, G20 in particular, representing the Bank of England, and the Chinese were very keen, and I had several discussions with the Chinese representatives about steps they could take to try and increase the demand for Chinese assets and Chinese government bonds, and essentially make it into reserve currency. The thing really, though, that is potentially a blockage there, and anything else that they develop, is for the US dollar. There's not only relatively free trade in goods, there's free trade in financial assets. Whereas there are distinct limitations on investment possibilities in China, restrictions on capital flows and so forth. And that certainly hobbles any efforts by the Chinese to make it into reserve currency. The other thing that's worth saying is historically, if you actually, I mean, the nature of a currency is, people use a currency because they know other people use it. I use pounds because I know you use pounds. And what that means is that once you've got something which is widely accepted as providing a reserve currency, reserve asset, and so forth, it becomes rather self-fulfilling and quite difficult for somebody else to break into. And usually when there are changes in what's the dominant currency, it's associated with some rather significant geopolitical events. So during the 19th century and the very first part of the 20th century, the dominant reserve currency was the pound sterling. And, that was associated with the empire and everything. And sterling was used throughout the empire. And other countries, including the US, would hold a lot of sterling assets. And then World War I came along, and then subsequently World War II, the empire started breaking up. The UK was no longer such a powerful financial centre, and the centre of gravity of the global financial system shifted to the US. So I think for the US to be displaced as the major reserve currency, you probably need something that just makes that lowers the importance significantly of the US in the world economy and in the world political system as well.
Yeah. We are essentially running out of time. I don't know if you're all right to just answer one.
I can stay on. Yes, I have no problem.
This is a particular one of interest to me. I've been looking at this relatively recently, but it says that current interest rates, while high by recent standards, are still low compared to medium/longer term standards. Do we need to remind people that these rates are still relatively low compared to like the 1990s and 80s in order to influence expectations, or is it helpful that people don't view interest rates in this way?
I think it is extremely useful to remind people of this. There had been a general drift down in longer term interest rates since the 1990s, even actually as late as the late 1980s. They've gradually been drifting down. In real terms, fallen by about 4 percentage points. So fallen from round about 2 or 3% to -1 or 2% in real terms. And there's been quite a lot of debate about what's been driving this. And I get most of the academic literature has come to the view that it's to do with the changing balance between savings and investment, that there's been a lot of savings going on, partly because of the joining of China into the world economy and the flow of savings out of there. But more generally, demographics as such has been a big lump of middle-aged people who do a lot of saving for their retirement. But also people have pointed to weakness of investment in recent years. There's actually a lot of stories that are out there. I've always thought that while the stories hang together, because we can't really get a stable empirical relationship that describes behavior over long periods of time, we should be wary of assuming that these low long-term underlying interest rates were here to stay. I should say that the dominant view in the academic world tended to be, the factors that have driven rates down would remain with us for some while. But I was very keen when I was at the Office for Project Responsibility that one of the risks that we should explore in one of our publications called the Fiscal Risk Report was to look at what happened if interest rates snap back. And indeed, that is exactly what's happened in the past year, as I've discussed. Now, they've only gone back sort of half the way, if you like, to where they were. A little bit more than halfway, maybe, but there's still quite a long way to go. But they might also fall back. And I think the fact that we don't really know what's going to happen, we don't really understand what's been driving them. The important thing for people making decisions, whether they're businesses, households, governments, is to recognize that rates may turn out to be very different from where they are at the moment. And you should plan for them to be different, whether that's much lower or much higher.